Hey, Renter Tires, it's Adam Schroeder here with another episode. And today I am joined by one of our prize lenders, that is Graham Parham with Highlands Mortgage. Graham, thanks for joining us today.
Oh, thank you, Adam. How are you?
I'm doing really well, and I'm hoping that after we talk, I'm going to have a lot more money in my pocket because you're going to help me get it out of all my properties. So,
we'll do the best we can. Let's do it that way.
So one of the problems we frequently run into is we talk with people who own investment properties and they have equity in the property, but getting it out is a pain because a lot of times lenders have no interest in doing a HELOC for you whenever it's a rental property, because rental properties are so dangerous, Graham. They're just such a gamble for banks that they don't want to do it. So I have to tell them, hey, maybe a local credit union will do it for you, because I think you were one of the people who told me a lot of times local credit unions are the place to go for this kind of stuff. But you, thankfully, and this is what I want to talk about today, is getting a HELOC on an investment property. You actually have a product where people can do that. So we wanted to bring you on to talk about the ability to do it. So if you wouldn't mind just telling us a little bit, I mean, most people probably know, but can you just run through what a HELOC is? And I know we wanted to talk about HE Loans too. You probably want to touch on those because I don't know how many people have actually heard of HE Loans.
Well, let's say HE Loans. That's pretty easy to talk about. Take Texas as an example. We were talking about you yesterday. A lot of purchase transactions for primary residence will utilize the HE loan. The HE loan is a close-in second loan. It's like a fixed rate loan, 30-year amortization, but it's in second lien position. People will typically use that for like a thing called an 80-10-10. You put 10% down, you get an 80% first lien, and then you get a loan on top of that, a second lien, which is a HE loan. That's at 10%. So that's a lot of times where they use it. Now, there are some investors out there that would be willing to take a look at the HE loan, like on a first lien position if they want to go that route, but I don't recommend that, because if you're going to go first lien position, you might as well use the 30-year fixed rate loan as we have it today versus the second lien position, which you say it's already high risk, so it's a higher price. So a lot of people that have purchased their properties that they say have a portfolio under 10, okay, I need to emphasize that. They purchase, let's just say 4 or 5 in the last 4 or 5 years, okay? Maybe they lucked out during COVID and they got their 4 or 5 or 6% interest rate, and they want to hold on to that. They don't want to let them go. You're one of them, of course. We talked about that yesterday.
That's on my primary. That's on my investment property.
Okay.
We've got people who've gotten, their investment properties with 3% interest rates who really don't want to let them go.
Yeah, and, it's almost like you can't have your cake and eat it too. And so if you want cake, do what?
But I like cake.
Yeah, okay. Well, if you have an investment property and you want to pull money out and you want to leave that first lien position alone, then you do a thing called a HELOC, which is a home equity line of credit. As you just mentioned that, credit unions are good for, getting HELOCs on primary residence. And if anybody's in the investment category right now purchasing properties, chances are they have a HELOC on their primary residence. They're great. I love them. I had it on my last house. I just haven't put it on this new one, but I think it's a great working tool on this, and you can utilize it the same way on investment properties. The problem that exists is that, the credit unions, the smaller banks, even some of the bigger ones, they just don't do HELOCs on our investment properties. So this company that we're associated with, they just came out with this about 3 weeks ago, and they basically kind of want to capture the market, which we've been getting a lot of excitement on because people have been sitting on the sidelines begging for this, and now here it is. Okay, so let me explain some of the features of these products. Okay, the HELOC, it is an adjustable rate program. It means that it's tied to prime. Prime right now is right at 8.5, and then there's an a margin that goes on top of that. And the margin on, let's just say, a $50,000, and the total loan to value would be 70%. You're probably looking at about a 175 margin. So that puts you about 10.25. So keep in mind, that's 10.25. Think about some of these private money lenders out there that are lending money, and you want to say, if I can't get a HELOC, I'll get some private money. We'll go for it. Those are at 11, 12, and, even 13%, where this is you have your own destiny. In other words, you can draw on it anytime you want, pay it down anytime you want, okay? There's a 3-year draw and a 10-year draw. And let me explain what that means is. You can pick and choose the 3-year or the 10-year, which means during that 3 years, you have check writing ability, which means you can pay it off and take more money out for the full 3 years during that 3 year. And then of that, and let's say you go all the way up to 3 years and you stop, you can't write anymore, but you got a balance. Well, that balance is still only interest only for 10 years, and it is on a 30-year amortization. The same way it works on a 10-year draw, you just get to draw for 10 years versus 3. Yeah, there's a little bit of pricing difference, but if that were me, I'd probably go with the 10-year, and here's why. Prime is at 8.5% right now. We know that prime is eventually going to come down after the Fed's talk today, maybe later on in the year. It's not going to be in this meeting. It's probably going to be around the September, October. But when that starts to have price cuts, and obviously we're hoping and being optimistic about a change in administration, so that could have an impact on the rates next year. But I think we're all confident that 25 we're going to see definitely some rate cuts. So when that happens, then prime comes down. We've already established your product that the margin's not going to change. The only thing that's going to change is the index, which is prime. Okay, so right now we're at 10.25, but let's say a year from now we got that prime down to like 6. Okay, now your rate's even better. So that's the great thing about the HELOC. Even though it's a variable rate, you're at the top of the realm right now as far as interest rates are concerned. The only way you're probably going to go is down in your interest rate. Okay, these are good for second lien positions as well as first lien positions. We can also do a first lien position HELOC. Once again, do you really want to do that? If you really want a working tool, then use it as a first lien HELOC so you have check writing abilities. If you're needing just the money, then you might want to consider just a first lien cash out. Okay. Minimum loan amounts are $50,000 and the maximum are $500,000. Okay. Credit score is only 680 or higher. Now, what we do is we take a look at your first lien balance. We take a look at the loan to value, the appraised value, or in this case, the market value. And I'll explain about the appraisal process here in a second. But we'll take a look at the market through an appraisal process. And if those numbers add up, then we're good to go. And what I mean good to go is the first lien position and the second lien position, the combined balance cannot be more than 70% of the value of the property. $300,000 property, you say you got $160,000 balance on the first. You want to take out a $50,000 HELOC. Well, now you're at 70% loan to value. You're good to go. Okay. These are fully underwritten. These are full doc loans. They're written just like a Fannie Mae loan. If you're out there in the DSCR world or you're outside the Fannie Mae 10 box, well, then you can't qualify for these loans. It's a very, very strict underwrite. As you mentioned a minute ago, I mean, investor products, investment properties as a whole, they carry a higher risk than primary residence. So there are some risk factors in there that they take into account for. So it's a great working tool. You pull that first straw, you have to keep it on the line for three months, and then you can pay it down and then just do your check writing, till the end of the term. But I highly recommend you could put one either on your primary residence, your secondary home, and or now investment properties. And that's 1 to 4 family properties that we can do this for.
So every check you write has to be for $50,000, or is it just?
No. Good question. No, only the initial draw. After that, once you pay it down, you can put $5,000, $10,000. I had a guy yesterday who says, well, what if I don't do anything for 5 years? Well, then you don't do anything for 5 years. If you're waiting for that, the index to come down, so be it. So you can use it anytime you want. But no, after that initial draw, you can do whatever you want. I think it's a minimum of $1,000. That answers your question.
Yeah. So I want to go back a little bit. You mentioned the prime rate, just for people's reference. In 2016 through 2019, before COVID hit, what was roughly the prime rate? Would it be like 4, 5, 3?
I'm close to 5. Yeah, I will say close to 5. That's a great question. I should look that up, but I'm going to guess around 5.
Okay, so they would have been looking at somewhere in the mid 6s to 7s for a HELOC rate.
Correct.
Okay.
And on second lien position product, that's still not a bad rate.
Yeah. All right.
Now, you could do up to 20 acres. And here's some other cool. There's no cash reserves. They don't have to have any HOA certificate from a condo project. the appraisals, which is kind of interesting, we do a thing called an AVM up front, okay? So we set up a scenario. The scenario is a $300,000 value of the property. I've got a 160 on my first lien. I want to take out a 50 on my second lien. Okay, fine. We're going to fully underwrite that loan as if it's a 70% loan to value, okay? There is no prepayment penalties on these things, but as far as the appraisal is concerned, we do an AVM product that we use through Fannie Mae. We go into the system and say, how much do you think the value of this property is worth today based upon the comprehensive data that Fannie Mae has collected, okay? If that report that we ask for, which is a free report, and it comes back at 300 or higher, we're good to go under that equation of 300,000 with the 160 first lien and the $50,000 second lien, okay? If for some reason the AVM does not work, then we send the appraiser out and he'll do a drive-by. Hopefully that'll work. If that doesn't work, then we have another appraiser go out and they'll do an interior and exterior appraisal with full rent analysis, okay? But from what I understand, if you get an AVM to work right up front, I'm like, you could close this thing within 2 weeks. I'm going to basically say 30 days or more, only because it is a broker type scenario. I have to send it to the investor to underwrite. The underwrite is a full Fannie Mae underwrite. DTI cannot exceed 50. You cannot have no more than 10 financed properties, just like the normal Fannie Mae rules. But there is no cash reserves. There's no HOA certificate. And if you even have an appraisal that was done less than 12 months, we'll take it as long as it makes the value. You get all that?
That was a lot to take in. So tell us a little bit. I know there's a cap, right? Can you? It's what did you say was about $2 million for the total portfolio for the cap?
Correct. The lender will give you up to and no greater than $2 million as a line. Okay.
Oh, okay.
They'll give you $500,000, but you cannot have. Let's see, the maximum combined loan cannot be more than $2 million. There you go.
And that's covering HELOC and HE Loan?
Correct.
Okay. All right. Fantastic. So you're looking at about a 10% rate for, the 10-year interest only. Then it obviously goes to that. So whenever it comes to investment properties and purchasing them, how do you personally, whenever you look at HELOCs, how do you utilize them whenever you're purchasing properties? Like, how do you factor that in?
Well, me personally, I had a HELOC on my last property, my last primary residence. And let's just say all of a sudden you give me a call. Hey, Graham, I got this property, just came up, availability. Nobody knows about it yet. Well, you want to take a look at it? Sure. But I don't have any money right now. I have a surplus of money, but I do have a HELOC. Okay. Well, I'm going to go grab that money out of the HELOC. I'm going to put it down on that particular property. I'm going to close on it. And then I'm going to come back, after I get some rent and everything else, I'm going to pay it off. And I'm going to do it all over again. That's the great thing about HELOCs. A lot of times people use them. I need to go buy a car. I need to do tuition. There's all kinds of things that you need money for.
Yeah. Now, one of the things that I've heard and people get concerned about is that, a bank could potentially just freeze your HELOC and say, yeah, no more. Is there any concern with that with the product that you're putting out with the investor? Will they potentially just come and freeze the HELOC and say no more?
It's hard to tell what investors are going to do, okay? And I know what you're talking about because after the 2008 mortgage meltdown, there was a lot of people on the West Coast that had large HELOCs. And we're talking $1 and $2 million HELOCs. And yes, they did shut those down, but we were in a credit crunch back then. We're not necessarily in a credit crunch right now. We're in a pricing crunch right now. So that's the reason why they shut those down. I have a strong suspicion that if you let it sit there for 5 years and you don't use it, just like a credit card, if you don't use a credit card after a certain period of time, then they'll send you a letter saying, your inactivity, we're going to shut it down. So I can't answer that question.
Okay. Well, I mean, that's fair enough. You gave a general answer there. So who shouldn't use this? Because obviously, every product that's out there, there's people who should use it. There's people who shouldn't. So in your opinion, as both an investor and as a lender, who shouldn't use this product?
I did an analysis on a portfolio of about 8 properties yesterday, and they showed me their first lien position, their principal and interest payment. I didn't even ask about the rate, didn't care. I was more concerned about what the P&I is. So what I did is I compared the P&I and tagged on the second lien HELOC at the 10 1/4, and then I came up with a ending principal and interest payment. Okay. Probably half of those, like you say, back during COVID, you got a 3% rate or a 4% rate or 5%, whatever the case may be. Don't worry about the rate. Worry about the dollars and cents. What is that first lien position doing for you? And I thought half of those, the ones I came back, I said, you really don't want to use this HELOC. I can save you $300 if you went with just a straight loan. So those are the kind of people I would probably talk out of the HELOC.
Okay. So
HELOC is a working tool. If they want it as a working tool, I'm not going to talk them out of it.
Yeah. Like, great. You don't think that today. I'm looking 10 years down the road, Graham.
If you make it that long, right?
Well, then you really don't have to worry about your balance if you don't make it that long. Other people can worry about that for you. So what are you seeing just in terms of, HELOC, HE loans, but also just moving off into more, real estate wise and the current kind of the lending market right now? You talked a little bit about the Fed's moves and their concern about, when on earth this year, if this year they're going to, do anything. What are you seeing in the lending environment right now? Like in terms of movement or, fear or, people ready to go? What are you seeing?
Well, you got a mixed bag of everybody. You got people still sitting on the sidelines because they listen to the news and all of a sudden the news says, hey, we're going to have a rate hike, or hey, we're freezing the loan or freezing the rates. We're not going to make them go down. And there's all kinds of different ways. But then again, when it comes to people that are looking for that 1% rule, Adam, as we know, that went away a few years ago.
Yeah. Have fun waiting.
Yeah. So the 1% rule is not there. And these people that may have bought, let's just say 5 years ago, and they had a 1% to work, well, great. But it may not be working today. And you see that a lot on the new builds, especially down in Florida, because of especially if you're going to do like a DSCR loan, which you have to give debt service coverage ratio. You're right there. It's that close. But I'd say a lot of people they're not really adopting that, marry the property, dating the rate, because they should, because you're selling assets that are going to be great tomorrow, just like they are today, but you're going to improve your cash flow down the road because the rents are going to go up, and in 25 years, you're going to come back and refinance, and then your cash flow is going to get even better. So I think that whole philosophy, people can adopt that. It's going to help a lot to get through the rest of the year to buy investments because people do want to buy. They're just a little nervous about these rates and about their cash flow. That's where your job comes in.
Yeah, you want a 1% rule. You buy a property now and raise your rents over the years. You get that 1% rule pretty quick.
Yep.
You can't worry too much. I love that. Are you seeing where are rates right now roughly? You mentioned the prime at about 8.5. What are you seeing rate wise for people?
We're probably in the 7 to 7.5 range right now, depending on credit score, percentage of down payment, property type, and so forth. But yeah, 7 to 7.5 for people above 740 or higher.
Okay. And that's for property, what, 250,000, 200,000?
Roughly, yes.
Okay. All right. So I think the HELOC, the HE loans, who would you recommend, between those two products, who is each one for when it comes to that?
The HELOC, once again, is a working tool. Okay.
Right.
Knowing that the market is going to improve, that rate is going to come down over the 3 or the 10-year draw period. Okay. The HE loan is a fixed, closed-in rate. Let's just say let's call it 10%. It's a 0.25% better. Okay. But it's there for 30 years at 10% principal interest. Okay. I personally would not get a HE loan. I would get a HELOC because you have more flexibility. The HE loans, a lot of times, if you're trying to purchase something and you got the first lien position guidelines that are going to support a second lien on an investment property, some do, some don't, but it's usually used for primary residence to eliminate that 20% down. You can backfill it with a 10% loan. And most lenders will do that, just depending on the state on that.
Okay. So, if you're saying that a HE loan would be a better option if the prime rate went down to 1 or something like that, then get the HE loan, lock in that rate and work off that.
Well, if you were to do it today, you're going to be at 10% on the HE.
Right.
And if you did it today on the HELOC, pretty similar, but the HE loan is fixed. It's not going down.
Yeah. So if the prime ever got down to 1 or something like that, then a HE loan would make a lot of sense because you'd lock it in at 3% or whatever.
Yep. Okay. Now, one thing about these HELOCs, they do have a floor of 4%. Sorry, we can't go any further than that.
The audacity.
I know.
To cap it like that. When it comes to having the HELOC, having the HE loan, how does that impact your lending if you go out and want to buy an additional property? And I'm not talking about just pulling the money out for that, but does having the line of credit help, hurt, not do anything? Obviously, they'll have to factor in payments into your DTI, but does having those impact your ability to get a loan in any way?
It's all math. If I went out and bought a $100,000 car tomorrow, I'd still have to factor that into my debt to income ratio. Same thing works here. Now, the cool thing about the HELOC, a lot of times, sometimes we pull credit, let's say they've got a $50,000 HELOC, but they got a zero balance. Well, that's not going to hurt them. Okay. But if they do want to utilize those funds, that HELOC, for this transaction for the down payment closing cost, that's fine. Just go to the lender after you pull the money, show me the new balance and show me the new payment. That will be counted against the DTI. But there's really, it's up to you, on a HELOC, because you can either pay it off or keep it in place.
Yeah. And I'm assuming that the interest is accrued daily, or is it monthly, or how is it accrued in this situation?
That I'm going to have to get back with you. It's on a 30-year fixed rate. That our 30-year term, that'll give you that.
Okay. Just curious if that impact, I wouldn't think it'd impact the payment much at all as you went through it, I would assume. And the HELOC, that's floating. It would change about every 3 months, potentially, couple months, in terms of.
If and when prime changes, that's when it changes. The margin is fixed. So let's just call it a 1.75, 1.5 margin. That's fixed. So here's prime today with the margin. Prime goes down, so does the rate.
Yeah. Speaking of margin, touch on that a little bit, because when we were talking, you mentioned things got quite a bit better recently. So when should you expect it to change in any way, shape, or form? Because things got significantly better whenever we were talking recently.
Well, yeah. When we first adopted this and brought this program on, if I'm not mistaken, I had to get it validated yesterday by 3 people that the margin was 3%, but today it's 1.75. So something happened where they said, okay, we got this 3% margin out there on investment properties where they're not getting any activity. So if they drop it down, they get more activity. So that's my guess.
Oh, okay. All right. So is there anything else about this that we need to touch on before we wrap it up here for our investors?
Just remember, you got to be inside the Fannie Mae 10 box. You can't have more than 10 properties. It's a 680 credit score or higher. It's a 70% combined loan to value. First lien, second lien balance against whatever you think it's worth. Those are the key components.
Now, when you say inside the 10 Fannie Mae, Freddie Mac loans, you don't mean if you have 20 properties, you can't do it, but you're saying you can only do it on your Fannie Mae, Freddie Mac loans.
No, what I'm saying is, if you have 20 properties and you have 20 liens, you can't get this product. If you have 9 properties and 9 liens, you can get this product.
Okay. All right. Well, fair enough. Fair enough to all investors out there. However, you can take out that HELOC and use those 9 to get you 20. That's definitely an option as you go through this. So, Graham, I really appreciate you joining us today. If anybody is at all interested in this product, which based on my conversations with investors, will be many people, reach out to your Rent to Retirement rep. If you don't have one yet, go to renttoretirement.com and schedule an appointment to talk with us, and we can get you Graham's contact information. I really appreciate the time you spent to educate us on the HELOC and the HE loan product. So if you have any questions about real estate in general that you want Zach and myself to answer or to send over to Graham, send it to podcast@renttoretirement.com. That's podcast@renttoretirement.com. Really appreciate the time you spent educating yourselves today. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.